And now, Lifestyles Unlimited presents the Real Estate Investor Radio Show. Over the next hour, we unfold your map to financial freedom. You'll learn how to retire through investing in single-family and multifamily real estate. You'll learn how to create cash flow and build wealth so you can have the time and money to live the lifestyle you want.
Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, we're working on your information flow. And we're doing so today by taking you to a place called Chattanooga. Now, it kind of has a funny name, doesn't it? Chattanooga. I mean, say it 3-4 times. Chattanooga, 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 Chattanooga. Sounds like we're running a choo-choo train or something, right? Well, Chattanooga is more than just a funny name. Chattanooga is a growing city in the great state of Tennessee. And it gives you opportunity as a real estate investor to make a lot of money. So what we're going to do is we're going to talk about Tennessee. We're going to talk more about Chattanooga. And more importantly, what I'm going to do is I'm going to get into a deal that came available to the Lifestyles Unlimited community. And I'm 100% sure that a Lifestyles Unlimited member has already acquired this property, is already working to renovate this property, and put this property into their portfolio as a piece of clean, functional workforce housing that is going to pop. It's going to pop. And when people come to look at it because they want to rent it, they're going to say, wow, I can see myself living here. And it creates an emotional attachment. Now, I'm getting way ahead of myself because if you're not a Lifestyles Unlimited member, like I know the majority of my audience is not a Lifestyles Unlimited member. I know you're probably not. Now, you over there, you are, but most of you are not, and that's okay because all of us that are Lifestyles Unlimited members, we started off not being Lifestyles Unlimited members. Me, I started off not being a Lifestyles Unlimited member. And then I discovered Lifestyles Unlimited like you're doing right now. And you know what I did? I joined. I did. I became a part of the organization. And the most important thing that occurred at that time was it transformed me from being somebody that wanted to do real estate into somebody that was able to do real estate. And I think that's a big problem for a lot of you out there. I think you want to do real estate. You've heard about the benefits of real estate. You've listened to this radio show for God knows how long, and we talk to you about what real estate can do for you. As a matter of fact, I'm going to talk to you about this property today and what it has the potential to do for you. But you have to understand the potential. And then you have to understand how you can take the potential and transform it into reality. And that's where the rubber hits the road. That's where you become a real estate investor. That's where Lifestyles Unlimited transforms you from what you are now into what you will be. Unless, of course, you're already a Lifestyles Unlimited member, in which case we've already done the transformation, so we're just working on the assets, right? Okay, so Chattanooga. Why Chattanooga? Of all places, of all the towns in the United States of America, why Chattanooga? Well, here's what we know at Lifestyles Unlimited. Chattanooga has housing stock that works well for what we're going to teach you about how to make money in real estate. Yeah, Chattanooga is one of those markets where everything we teach works exceptionally well. Now, I'll be the first to tell you that there are parts of the country where what we teach you, it doesn't work. Places like California, places like New York City. And the reason for that is because the price of the assets is so out of balance with what you can charge for rent that the math doesn't work. The math doesn't math. And what it does is it sets you up for either having to take a lot of your money and put it into an asset, which is really an ineffective way to invest, or take negative cash flow. Yeah, either one of those allows you to invest in California or New York City, but it negates the benefits of being a real estate investor. it negates the 5 different ways we make money in real estate because you're doing it wrong. So rather than invest in places where it doesn't make sense to invest, we invest in places where it totally makes sense. And Chattanooga is one of those places. So Vincent sent me a property. Now, again, I'm going to preface and tell you that this property is one that Vincent sent me a couple of weeks ago. So I'm 100% confident after you hear this deal, you're going to go, wow, I got to buy this. But I'm 100% confident this deal is already gone. It doesn't mean Vincent can't find another one for you, but this one's probably gone. So what we're going to use this for is for educational purposes. I want you to start thinking like a real estate investor. Even though you haven't had the formal education provided by Lifestyles Unlimited, I want you to get your mind where your mind needs to be. And your mind needs to be, I'm making money. That's what real estate can do for you. Now, let me just describe this property to you. It's a solid, all brick construction, 4-bedroom, 2-bath property. The location is in an attractive area in a mid-century home, which means it's kind of old. It was built in 1955. That sits on a large corner lot in a great neighborhood close to downtown Chattanooga. Has a large open floor plan with hardwood floors, a newer roof, that's kind of good to know, and HVAC. So would you buy it just based off of what I told you? Probably not, right? Because there's nothing there that makes you go, wow, this is the screaming deal. This is the deal I've been looking for. No, those are just factual components about the property and where it's located, how it was built, and we can't change any of that. We're not going to move the house. We're not going to reconstruct the house. We will rehabilitate the house, but we're not going to reconstruct the house. There's no reason to add on a bedroom or a bath because the size of a 4-bedroom, 2-bath is adequate for quality rental property. Now, Vincent sent me a picture of this property, and it's kind of, it's unremarkable. I mean, it looks like an all-brick house. It's got a roof. It's got a chimney sitting right in front. It's got a little porch. It's got windows. It's got some landscaping. Yeah, nothing special. But here's what we can do as Lifestyles Unlimited members. We can understand the opportunity, and we can transform the opportunity into reality. In the next segment, I'll talk to you more about this asset. Stick around. Welcome back to the show. So I hit you with a lot of information in the last segment. You know what I'm going to do? I'm going to hit you with more information in this segment because what I want to do is I want to help you shape your mind. The problem you're dealing with when it comes to real estate investing is that you're so ingrained with what you're doing now for investing, you don't know any other outlets. You don't know any other paths. You don't know any other way. You do what you've been conditioned to do, which is to take money out of your check, stuff it into a 401k, maybe you're putting it into an IRA, maybe you've got a teacher plan, maybe you've got some other government-endorsed retirement plan, and you're just putting money in there and you're praying it's going to go up. Now, if you've been tracking the stock market, it kind of did okay, right? It did okay effectively last week. I mean, I was looking at it and, things seem to be shaping up for you guys in the stock market. You dodged another mini correction. But what happens when the stock market decides it doesn't want to do a mini correction? What happens when it decides? Because it will decide. You will have no input on it. You will be riding the train downward when that stock market decides it's going to crash or do a major correction. And then what? What do? Do you kind of lick your wounds and do dollar cost averaging and hope it's going to come back, kind of like it just did last week? Okay, that's a methodology. But there's a different methodology, which is buying real estate that you don't know how to do because nobody's taught you how to do it correctly. I mean, you've probably read a few books. You've probably listened to some podcasts. You've obviously listened to me. Maybe you've listened to Del Walmsley, the founder and CEO of Lifestyles Unlimited. Maybe you've listened to my fellow co-host Andy Webb. And what we're sharing with you is information about how to do this correctly. But the most succinct way to do this correctly is to get the actual roadmap presented to you by Lifestyles Unlimited. Because when you have the roadmap, you have all the paths that you can go down. And one of those paths is the path that we're talking about today, which is single-family investment. Now, some of you don't know this because you haven't been educated. That's totally fine. And I'm going to share this with you. Single family may not be the path you need to take. Yeah, I'm serious. Single family may not be your path. Your path may be in the multifamily space, or your path might be in both. So when I'm talking about single family assets, I'm giving you an indication of what could be, but it doesn't necessarily mean that this is the path that you have to pursue. Kind of crazy, huh? Kind of getting you thinking, right? Thinking about the opportunities, thinking about the possibilities. So what we're going to do is we're going to present to you this property that Vincent presented to me a couple weeks ago, which I know is off the market now, but we're going to use it as a learning venture because I want you to understand what you don't understand. Now, I'm looking at this house, and it's not really impressive. I mean, it just kind of looks like a house that was built in 1955. It's got very, very modest landscaping around it. It looks like it's got trees touching the roof, which is a no-no. There's some dark soot around where the chimney vent exits from the chimney piping. But other than that, it looks okay. Curb appeal? Yeah, not much curb appeal. But what do you expect from a property that was built in 1955 that maybe is in a distressed state of affairs? You shouldn't expect too much out of it. I mean, the real selling points of this property, from my perspective, is the location, the proximity to downtown. The fact that if you have a potential renter, and that potential renter works downtown, which, by the way, a lot of potential renters, let me say that again, a lot of potential renters live downtown and work downtown. And they like that. They like that urban environment. And this would be a property that would fulfill a housing need for somebody, some family, that's looking for housing in close proximity to downtown Chattanooga. So I think the potential is there. Now, the age of the property, it's up there. Yeah, you can do the math. Yeah, 60, 70 years. Yeah, it's been around for a while. But it's brick construction. Brick construction tends to do okay. But what we don't know about this property are the things that we don't know. We understand that the roof might be a newer roof, but how new is it? Is it 2 years old? Is it 5 years old? Is it 10 years old? Does it have any indication of hail damage or any other effects that may have damaged the roof? These are things we need to know. What does it look like on the inside of this property? I don't know. I know there's hardwood floors because Vincent said there's hardwood floors. And I know there's an HVAC system in there. So chances are it was added somewhere along the line. Because I don't think HVAC was a big ticket item in the 1950s. I really don't. And when you consider the weather patterns of Chattanooga, this may have been a property that was built without HVAC because they just didn't feel that it needed it. They felt that they could open up the windows, the breeze would provide the cooling effect, and that's just how Americans lived before the invention of HVAC. Kind of interesting, right? Okay, so it's got some things going for it. We don't know anything about the foundation. Now, I will tell you, Tennessee properties do, from time to time, suffer from shifting soils, which creates foundation problems. So we've got to look at the foundation. We have to figure out, do we need to fix the foundation? We've got to take a look at the major systems in the property. We need to make sure everything is in good working order. And if it's not, we're going to repair it or replace it to make sure it's got at least a 5-year lifespan. Did you notice what I just told you? That we're going to repair or replace it so that it has at least a 5-year lifespan? Now, why do we do that? Here's why. We fix or replace everything that could potentially go wrong in the next 5 years because we don't want to fix it or replace it in the next 5 years. Yeah, chances are it's not going to fail in the next 5 years. And that's important because maybe we've got a holding plan. In other words, we're going to keep the asset for about 5 years. And maybe in 5 years, we'll sell the asset to somebody else who wants to buy it. Maybe we'll even sell it to the people that are living in it. And at that time, around that 5-year time, that's when things may be in a condition to where they may stop working again. And we want to be out of the property when that happens again. So we're going to fix or replace everything that could go wrong in the next 5 years to new or like new condition because we don't want to deal with it. And we don't want our residents to have to deal with it either. Kind of a cool philosophy, right? Yeah. That's one of the things that we don't like as real estate investors. We don't like our residents to be inconvenienced, and we don't like to be inconvenienced by repairs that could have been avoided. In the next segment, I'm going to get into the financials of this property. Stick around. Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. My name is Al Gordon, and as always, we're working on your information flow. And we're doing so by taking you to a place called Chattanooga where you've probably never set foot before, but hear me out. Maybe you want to set foot there because maybe Chattanooga has a great housing stock that is waiting for you to buy. Housing stock that you can buy, you can renovate, you can put back into service, and you can make it a place that somebody is going to call home where they're willing to give you a third of what they make every month in exchange for the right to live there. And they'll sign a 1-year lease, and they'll agree to pay you every month on the first of the month, again, with 1/3 of what they own or earned. It's kind of cool. Now, some of you are going, wow, it sounds like usury, dude. Sounds like you're abusing people. No, I'm not. What I'm doing is I'm offering a great place to live to anybody that's looking for a great place to live. And as long as they satisfy my rental conditions, in other words, they have to make a certain amount of money, they have to meet certain expectations that I apply to everybody because I treat everybody fairly. If they meet those expectations, I will enter into a lease agreement with them and I'll allow them to live there for the next year and pay me 1/3 effectively of what they make every month. And they're happy to do it because that's what the cost of renting a property is in the greater Chattanooga market. As a matter of fact, that's what the cost of renting a property in almost all real estate markets is. Most people tend to spend about 1/3 of what they make on housing. That's you can go ahead and look that up. Go ahead and put it into AI. Ask that question. How much do people spend on housing? You're probably going to get all kinds of answers. But just know that's the way it is. It's the way it was when I was renting property as a resident myself. I've been in the situation in my life where I rented, I didn't own. And one of those situations was when I lived in California. I couldn't afford to buy a house in California. I was forced to rent. So I rented. And I gave up 1/3 of what I earned every month to live in what I thought was a pretty great place to live. And it was a great place to live. And then I moved on and I got married and eventually got to a point in my life where I made enough money that I could afford to buy a house. And that's what I did. I bought a house. And guess what I spent? About a third of what I made every month on that house. It's just the way it is. Okay, if I beat that horse to death, are we going to let that horse go? Let's let that horse out of the pen. All right. Let's get back to this property. This all brick property with kind of a gray roof. It's not really a flat roof. It's got a pitch on it, but it's not a big pitch. It's kind of a flatter pitch, kind of like you would see in a 1955's build in Tennessee, especially in Chattanooga, just outside of downtown. So what else do we know about this property? It's almost 2,000 square feet. So it's a little on the bigger side of what we like to buy. But again, it's a 4-bedroom, 2-bath. So that would qualify why it is a little bit bigger than what we consider the sweet spot. Oh, you don't know what the sweet spot is? Okay. Sweet spot for Lifestyles Unlimited members. 3-bedroom, 2-bath, 2-car garage, approximately 1,500 square feet of living space. That's what we consider the sweet spot. We'll buy them a little bigger. We'll buy them a little smaller, but we like that 1,500. So this one's a little bigger. It's almost 2,000 square feet. It's got an extra bedroom. That's good. It appeals to families. It appeals to families that need 4 bedrooms that want to live in proximity to downtown. I think it's a great little property. So let's dig into the financials. Let's see if financially, if this property makes sense. Now, the property was on the market for $195,000. And it sold. I know it sold because I asked Vincent, and he said, yeah, it's gone, man. Sold to the Lifestyles Unlimited member. I went, sweet. Okay, back to the property. $195,000. Sound like something you want to spend $195,000 on? Just write a check, $195,000? Well, that would be ineffective, first of all. We don't do that at Lifestyles Unlimited. We leverage everything that we do because you get better rates of return based off the fact you put less money into the asset. And you allow other people to take risk with you in the asset in the form of loans. And it's actually a good relationship because they will take their money in the form of interest and points. We'll take our money in the form of cash flow and appreciation. And we like that very much. They bring a lot of the money to the table. We bring some of the money to the table. We get all the benefits of appreciation. We get all the benefits of cash flow. It's a nice thing. What's the property worth if it's all fixed up? What do you think a 4-bedroom, 2-bath built in 1955 in close proximity to downtown Chattanooga is worth all fixed up? In other words, everything is brought back to life. Well, Vincent says it's worth $345,000. That's market rate for a property in pristine condition. This property is not in pristine condition. We know that from the price at $195,000. Now, we haven't got in it, but we can assume that there's a lot of things wrong with it. It might have foundation problems. We got to check the roof. We still got to check that HVAC, make sure they're all serviceable, make sure they've got a 5-year lifespan on them. We got to get into the property. We got to make sure that the kitchen looks good, the bathrooms look good. We got to make sure everything is painted and it's appealing on the interior. It's got to look like home to somebody. And we know how to renovate it to make it look like that. Now, on the exterior, you know what we could do to really spruce this thing up on the exterior? Because it doesn't have a lot of curb appeal, but it's brick. And I bet you this brick has never been pressure washed. I bet you if we pressure wash the brick, we're going to restore the luster of that brick because it just looks faded and dirty. And I think we can breathe new life into the front of this house just by pressure washing the outside. And then the landscaping that's around it, it's not bad. It's just kind of immature. We need to give it a chance to grow and season. And maybe we need to trim it up a little bit, make it look really nice. I think that'll give it some great curb appeal. But what does all that curb appeal have to do with the fact that the property might be worth $345,000 all fixed up? Everything. That's part of what goes into that $345,000 price point. But again, we can buy it for $195,000. Now, it's going to take about $34,000 for us to do this deal. Even using hard money, we're going to have to put about $34,000 into this deal. But we're going to capture an additional $68,000 of equity in the deal. So in other words, we're going to put about $34,000 in. We're going to capture about $68,000 worth of equity. You know what that really works out to be? About a 200% return on capital gains. You heard me correctly, about a 200% return on capital gains. So we're going to take $34,000 of our own money, and we're going to put it into the deal. And we're going to keep all of our expenses of acquisition and renovation on this property to a wholesale pricing, to where it allows us to command an additional $68,000 of equity, in addition to the $34,000 of equity we bought by actually putting cash into the deal. It's a lot of equity, folks. I mean, you think about it. It's about $102,000 worth of total equity. And it only cost us $34,000 to buy $102,000 worth of total equity. That's a game changer. I haven't even talked to you about the other ways we make money in real estate. So I'll do that in the next segment. Stick around. Welcome back to the show. So in the last segment, I was giving you an indication of the money that we can make on this asset. Did you hear it? Did you hear that you could take $34,000 and turn it into what? $102,000? Did you hear that? Did you think that was mumbo jumbo? Some of you heard that and you went, yeah, this guy ain't for real, man. This guy is blowing smoke up our chimney. Am I? Not really. Not really, not at all. Because when you learn how to do this correctly, you learn the fundamentals of real estate. You learn what real estate is really worth in its present condition. You learn what it's really worth in its future condition. You learn how to manipulate the property, to breathe new life into it, to make it look like it once looked, and maybe even better. You make it presentable. You make it so that somebody wants to live in that property, and they're willing to compete for the right to live in that property. You're taking $34,000. You're injecting it into the deal, and you're capturing an additional $68,000 of equity. That's a 200% return on capital gain. Now, I know the stock market's been doing good for you, right? But have you been making a 200% return on your money the moment you bought an asset? And the answer is no. That's not how it works in the stock market. You know that, and I know that. But it works differently in real estate, especially when you know how to buy correctly. So what else does this property do for you? Well, it produces something called cash flow. Cash flow is very important because you use that cash flow to replace the earned income in your life. So what does that mean? That means you have an asset that's producing money on a monthly basis. That money comes into your household, and you can do whatever you want with it. This isn't a glorified retirement plan sponsored by the government that tells you can't touch the money. That is not allowable. You can do whatever you want with the money. Now, in this particular deal, we believe the cash flow to be about $368 per month. Now, can you retire off of $368 per month? Short answer is no, probably not. Not unless you got something else going on in the background that we don't know about, right? That's a lot of money to try and live off of, right? $368? Not a lot of money to live off is what I meant to say. Okay. So you can't retire off of one property. What if you had 10 and that number was really $3,680? Could you retire off of that? Well, maybe yes. Some of you could. Some of you, no, not a chance, right? What if you had 20 of those properties? 20 of those properties producing almost $8,000 a month. Now we're getting somewhere, aren't we? Could you live off of $8,000 per month? Knowing that you don't have to stop at 20 properties, you could buy more. So if you wanted more money, you just go out and get more money by buying more assets. It's just the way it works. Or you look at that initial asset that you bought, say 3 to 5 years ago, and you decide to sell that initial asset, take all the money out of it, and you buy 2 or 3 properties to replace it. That's kind of how we do it. That's how all this works. Yeah, I'm getting into advanced strategies, but that's how it works. But what I want to do is I want to get your attention. I want you to understand that just one property can get you in the door of real estate investing. It probably can't retire you, but it can do some significant things in your life. For instance, turning $34,000 into $102,000. That's pretty significant. Providing you $368 a month in cash flow. Now, when you annualize that, you're getting about $4,400 per year. A $4,400 injection into your household. What can you pay with that? Maybe that covers your insurance bill. Maybe that covers your grocery bill. Maybe it covers some other bill or maybe 1 or 2 of your bills. That gets you started. So then you buy another property. And maybe that other property does the same thing as this property would do for you if we bought it as property number 1. Maybe you get 2 properties producing $368 per month in cash flow. It's like what, $750 a month? I mean, I'm averaging $750 per month. Think about what you could do with $750 per month. You could do a lot of things. You could replace your income with it. You could take your wife out to dinner with it. You could take the money and set it aside for the next asset you're going to purchase. I'm telling you, man, I am telling you. There's a lot of really good things that you can do with that money. Now, so far I've talked to you about 2 ways that we make money in real estate. The equity capture, which is kind of a big deal. The cash flow, which is definitely a big deal, because that's not one and done like equity capture. Cash flow is perpetual. Pays you every month. What other ways do we make money in real estate? There's natural appreciation. We know that properties tend to go up about 3.5% per year in value across the board, across the nation. It's kind of what real estate does. It just tends to appreciate at a slow trickle rate. But that allows us to capture additional equities in the property because the value of that price is going up. But we thought it was worth $345,000, right? But what is it worth later on? Well, after 1 year, that 345 turns into like 357. After 2 years, it turns into 369. After 5 years, it turns into like $410,000. So you're making money just off the fact that the property is naturally appreciating. We make money with something called principal paydown. See, I told you we leverage all of our properties, right? We bring lenders in to assist us with the money because we don't want to spend all of our own money. We use their money, and they're glad to lend it to us. So when we make a mortgage payment on the property, a portion of that mortgage payment goes to interest, which is a write-off. It's a business write-off for the asset. And the rest goes to principal paydown. So in other words, a portion of what we pay every month is reducing the amount that we owe on the loan, thereby increasing our equity again. Pretty cool, right? Now, there's another way we make money in real estate that I really haven't talked to you about, but I'm going to tell you about it now. And it has to do with something called taxes or tax advantages. See, the Internal Revenue Service has regulations that govern how we're supposed to account for all of our real estate. And one of the things that they have us do is they have us take a paper loss. It's not a physical loss. We didn't actually lose any money, but it's a depreciation loss. So how this works is that the government has us determine what the value of the property is. We in this particular deal that we're talking about here, we determined the value of the property is what, $345,000? Okay, so then we're supposed to determine how much of that value is in the land and how much of that value is in all of the things that are built upon the land, all the improvements. And what I tend to do is I tend to say that maybe about 20% of the value is in the land and 80% of the value is in the improvements. And that gives me my depreciation. Now, I can't take the land value. I have to carve that out. But all the improvement value, I can use that for my depreciation write-off. So I take that value, 80%, and I divide it by 27.5. Why 27.5? Because that's what the government says is the expected lifespan of your asset. It should last 27.5 years. Don't ask me how they came up with that number. I don't know, but that's the number we use. So we take that depreciation write-off and we apply it to the income stream that we make on the property. And you know what happens? We get to keep all of the income effectively tax-free because the depreciation write-offs, especially in this particular deal, are greater than the income that we're going to make on the property. As a matter of fact, the depreciation write-off on this asset works out to be about $10,000 per year. We're making about $4,400 in income. So that's going to leave us about $5,600 in depreciation expense that we can use on anything else the IRS allows us to use it on. We could even use it on other income-producing property if we wanted to. It's a nice advantage that the government gives us. So at the end of the day, whether you've heard of Chattanooga or not, I want you to consider Chattanooga as a potential place for you to invest your money, even if you don't live in Chattanooga. Because at the end of the day, when you become a Lifestyles Unlimited member, you're going to have the keys to how to get this done. If you want to do what I'm doing, you want to do what the members of Lifestyles Unlimited are doing, go to lifestylesunlimited.com, sign up for a free workshop, and let's get you going.
Thank you for listening to Lifestyles Unlimited's Real Estate Investor Radio Show. Ready for more of the map? Visit lifestylesunlimited.com. Explore our videos and articles. Click on the radio tab to access past show podcasts. View the radio show schedule and listen to our best of radio shows. Want to continue the conversation? Follow Lifestyles Unlimited on Facebook today. We want to meet you as well. Sign up for a free workshop at lifestylesunlimited.com. Until next time, remember, it's not the money, it's the lifestyle.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers and do not necessarily reflect the opinions of this station, its affiliates, its management, or advertisers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.